Hi, this is Luke Frobe. I'm the co-author of Managerial Economics, a problem-solving approach, along with Brian McCann. This lecture is designed to supplement Chapter 2. Last lecture, we showed you how to align the incentives of employees with the goals of an organization. By this we meant give employees enough information to make good decisions and the incentive to do so. This lecture shows you how to identify profitable decisions in general. We use a simple metaphor that profitable decisions are those that move assets to higher valued uses. This simple metaphor can be applied to almost any decision to figure out whether or not it's profitable. For example, when TVA was making the mistake by not paying the overtime, it was resulting in barges being left at the docks. If you think about the barges being the asset, barges left idle at the docks is obviously not the highest value use for the barge. Where does this idea come from? The basic idea comes from capitalism. In a capitalist society, wealth is created when assets move from lower to higher valued uses. And here we measure value by willingness to pay. That means you've got to want the good and you've got to be able to pay for it. And the chief virtue of a capitalist economy is its ability to create wealth. If you just leave people alone, they will voluntarily transact and move assets from lower to higher valued uses. Let me give you a simple example. Suppose that a buyer values a house at $130,000 and a seller values the house at $120,000. They get together and bargain, agree on a price of $128,000. That splits the surplus created by the transaction. So $10,000 worth of surplus is created by the transaction. The price tells us how to divide the surplus between buyer and seller. You can think of almost any transaction in the economy, short of coercion or theft. It's almost a tautology to say that if people voluntarily transact, they both must be better off, otherwise they wouldn't transact. Which raises the obvious question, why are some countries so poor? Why are some countries so rich? And the reason is that governments play a crucial role in the wealth-creating process. They facilitate the movement of assets from lower to higher valued uses. And they do this by enforcing contracts and protecting private property. Economists study the public policies that facilitate the movement of assets to higher valued uses, and they evaluate policies by whether they increase efficiency or decrease efficiency. And by that they mean an economy is efficient if every single asset is in its highest valued use. And obviously, you're never going to have an economy like that. But it's a useful benchmark for determining whether or not a policy is moving us closer to efficiency or further away from efficiency. Economists look for inefficiencies created by public policy and then suggest changes in public policy to get rid of the inefficiency. Business people look for inefficiencies too, but they have a completely different reaction. They want to exploit inefficiency by moving the assets to a higher value use and make money in the process. What creates inefficiencies? Well, inefficiencies are created when there's policies that prevent assets from moving to higher valued uses. And you can think of price controls as a simple example. Let's go back to our simple housing example. Suppose that there's a price regulation that prevents sales at prices above $110,000. $110,000 is below the seller's bottom line, so the seller's not willing to sell at that price. And so the price ceiling, the price control prevents the asset from moving to a higher valued use. Similarly, taxes can deter wealth-creating transactions. Imagine a 10% sales tax paid by, say, the buyer. He's going to have to pay at least $12,000 in sales tax because the price has got to be between $120 and $130. Either way, there's not enough wealth created by the transaction to pay the tax. In the 70s, the United States had limits on what banks would pay for deposits. So banks are intermediaries. They borrow money from depositors and lend money to small businessmen and people who, want to buy a house. And they make money on the spread. They borrow at, say, 5% and lend at 10%, and they're making 5% on every transaction they make. Now, in the 70s, there was a limit on how much they could pay to depositors. So they would pay depositors, 5.25%, and that was a price ceiling. They wanted to encourage more deposits so they could lend more to borrowers, but there was a price ceiling and they weren't allowed to do that. And so you think about an economist say, hey, there's an inefficiency, let's try to figure out how to get rid of the public policy. A business person would have a totally different perspective. They would think, hey, there's an unconsummated wealth creating transaction there. How can I consummate it? Well, some clever business person figured out how to do that, and that was the invention of Eurodollars. Eurodollars are dollar-denominated savings accounts in European banks beyond the regulation of the U.S. Federal Reserve. So European banks were free to pay depositors higher rates than 5.25%. Their success at attracting deposits eventually led the Federal Reserve to abandon its regulation, cue the price ceiling on deposit rates. I want to end with a plug for reading the book, taking the course, figuring out what to do. And, well, let me just tell you what would happen if you ran a company filled with employees who weren't trying to identify profitable decisions that move assets to higher valued uses. First of all, there's two sources of pressure that come to bear on any company in a capitalist market. One is product market competition. If you can't figure out ways to move assets to higher valued uses, your rivals will, so you'll end up out of a job. The other source of pressure comes from financial markets, what economists call the market for corporate control. A company is a large collection of assets, and if somebody else out there sees those assets and say, hey, there's something they could be doing to make more money, all you have to do is go out to the capital market, convince some financiers to lend you money to buy the company. You can fire all the incumbent management and move the assets of the company to a higher valued use. Our economy is littered with companies that either got put out of business through product market competition or through the market for corporate control, where they were taken over and fired from their jobs because they weren't identifying profitable decisions that move assets to higher valued uses. So that brings us to the end of Chapter 2. We've shown you how inefficiency implies opportunity and how the tools of economics can be used by business people to identify assets in lower valued uses so you can figure out a way to profitably move them to higher valued ones.